Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with silverdoctors.com, and back with us today is Dave Kranzler from Investment Research Dynamics. Dave, thank you so much for joining us today.
Thanks for having me, Elijah. It's always good to be here.
Definitely. Now, I'd first like to discuss the Fed's balance sheet, because you recently wrote an article about how really what's happening with the Fed's balance sheet, it's increasing. And now, the Fed claimed that it was supposed to be normalizing its balance sheet a couple months ago, but since then, the balance sheet has actually increased by $7 billion. Did you want to discuss this?
Sure. I mean, it depends on, where you mark when you measure the Fed's balance sheet, but essentially net between the end of September and the last Fed balance sheet report, which was last Wednesday, the Fed balance sheet actually increased. And if you recall, they announced in September that they were going to start shrinking their balance sheet, which means they were theoretically going to start withdrawing some of the liquidity from the system that they put into the system with their massive QE program. I don't even like to call it QE. It was really money printing. And the methodology to start was to let the bonds that mature in October just bleed off. So just mature and not replace them. And it looks like, to the extent that anything matured, it looks like they've replaced it. And I haven't drilled down deep enough to see if they replaced what matured in October with mortgage paper or rolled T-bills forward or whatever. But the fact of the matter is they were supposed to, allegedly they were going to take down their balance sheet by $10 billion. And $10 billion is nothing. I mean, it's infinitesimal compared to the north of $4 trillion that the Fed's printed, not to mention the multiples of that $4 trillion that they've enabled in the form of credit expansion. But the point being here is we were supposedly going to get a bunch of interest rates rises this year. We've had two, and it looks like now they're starting to pull the, give us the Olay on the December rate hike. Looks like that's not going to come. I guess James Bullard, one of the FOMC members, was out on the tape saying he doesn't see a need for a rate hike in December. And now they're giving us the old Olay on shrinking their balance sheet. So you have to ask yourself, what's the signal that they're sending? Why are they reluctant to raise interest rates, and why are they not removing liquidity from the system? And, all indicators point toward the fact that if they were to do that, the stock market would probably start to collapse, and also the bond market.
Right. And one of the things that you've talked about is the 10-year Treasury yield. What's happening, it's been increasing actually by 36 basis points over the last 2 months. What is the significance of this?
Well, it's kind of, again, it's a muddled signal, because the central banks have interfered to such an extent in the sovereign bond markets by buying sovereign bonds, printing money and buying sovereign bonds, that the traditional signals and the traditional price discovery mechanism that which is how Treasury markets are supposed to function. They're supposed to measure sovereign credit risk, and they're supposed to measure the risk of future inflation. Well, they've kind of removed that function of sovereign bond markets, and I'll just specifically talk about the Treasury market here in the U.S. They've removed that function with all the intervention. So if you've got, say, and again, these numbers are off the top of my head, but if, say, the 10-year Treasury bond is yielding, I don't know, where is it, 240 right now or something, that would say, oh, well, inflation's probably running plus or minus 2%. Well, I don't think anyone in your audience would testify that inflation, the things that they spend money on every day, have only gone up 2% in the last year. So to the extent that Treasury yields are rising like that, and they're actually starting to rise at a faster rate on the short end, that tells you that, initially the market might have been pricing in this notion that the Fed was going to raise interest rates, but the Fed isn't. So what's happening here is that it looks like the Fed may be losing its ability to mute the pricing effect of inflation into the Treasury market. And we saw that this morning when the PPI for October was released, and it was a hot number, and the short end of the market gapped up. So, and the curve actually flattened, which tells us, if we go by the traditional signals of a flattening curve, it tells us we're going to have a recession is starting. So, to the extent that the 10-year, and I believe as a percentage of its holdings, I think the Fed owns the highest percentage of 10 years. So they've worked the hardest to try and control the price and the yield in that part of the curve. And there's a reason for that, and that's because housing mortgages are priced off 10-year treasuries. A lot of other things are, but primarily, the big enchilada there is trying to control the housing market and mortgage rates. But if they're having trouble holding down the yield at the 10-year, in the 10-year area, it tells us that inflation is running a lot hotter than what we're being told by the quote-unquote official government CPI numbers.
Definitely. And can you expand a little bit on why the bond market right now is, as you've been saying, we were just talking before the interview, and you were saying that the bond market is really kind of, the investors in there are realizing that inflation is ahead. And you can see that just by how the bond market is acting right now.
Well, we're starting to see inflation. We're starting to see price rises in the government measurements of inflation, the CPI and the PPI. So today, for instance, the PPI was released, and producer prices went up at the fastest rate in 6 years. And the last couple CPI reports generally have been running higher than the quote unquote Wall Street consensus was looking for. So, and I mean, let's be clear about one thing. The government, with its CPI index, doesn't measure inflation. It doesn't show inflation because the government's not measuring inflation. I mean, ever since Nixon closed the gold window, Arthur Burns, when he was head of the Fed, they decided they needed to rejigger the CPI measurement to mute inflation. So, to the extent that the government measurements are not muting insipid inflation, tells us that inflation is really running a lot hotter than people realize. And that's why I think you're seeing downward pressure on Treasury bond prices, which translates into higher yields. And that translates into much lower prices for junk bonds and much higher yields, because the risk of inflation getting out of control is starting to be reflected in these fixed income markets.
Yeah, I know shadowstats.com, Shadow Government Statistics, kind of gives interesting light on how the government seems to be manipulating the inflation index, the CPI. Officially, inflation right now, it looks like, I'm looking at the chart right now, it looks like it's 2%. That's what the government is reporting. But really, if you kind of take all the manipulation out of those statistics, Shadow Stats calculates it anywhere from about 6% to 10%. Now that might be a little bit more about how people feel inflation is, just the average person seeing prices go up and up. So can you expand a little bit on how this is impacting things? Because it's not just that prices are rising, it's also, and it's not just the CPI being manipulated. If the CPI in the inflation index is being manipulated, then that distorts a whole lot of other data that we see. For example, GDP. If we look at inflation-adjusted GDP right now, real GDP, and we adjust it based on what inflation really is, so taking away the manipulation out of the inflation index, we see that GDP would actually be negative, and you've reported on this. So it looks like the economy is doing a lot worse than we're told right now.
Yes, and actually, I subscribe to shadow statistics, and it's an invaluable tool. It's not on a monthly basis. It's not very expensive, and it's very worthwhile reading. And it's they're long reports, a couple times a week, and once you read through a few of them, you kind of get a sense for how they're organized, and you can sort of open up the report and go to the sections that you're most interested in. So you don't have to read the whole thing every week and feel like you're not getting your money's worth. You just have to read a couple paragraphs and you get your money's worth. But what he does is he actually looks at, so the government all the time now, they change the way they calculate the CPI index. They substitute products. For instance, if they're measuring a certain type of, certain ice cream product, and that price of that premium ice cream product rises, they'll say, oh, well, consumers will substitute for the generic ice cream, and so we're going to use that in our index instead. And that's nonsense, because everyone knows that generic ice cream stinks, and unless it gets really expensive, you're going to keep buying the premium ice cream despite the price rise. You just might eat less of it. But anyway, that's just an example of how they rejigger the basket of goods that they measure. So what John Williams does is he'll say, okay, let me look at how the government measured inflation via its CPI index in 1990, and because he's been tracking all these numbers for probably close to a couple decades at least, and so he recalculates the shadow statistics alternative inflation number, and it is, I think the last one I saw last week or the week before, I forget, was I think he had inflation as the government would have calculated it, say in 1990, is running around 6%. So, and I might have slightly bastardized the example there on how he calculates it, but it's that concept. He actually uses previous methodologies of how the government measured inflation. So it's not like it's a pie in the sky number that he's coming up with. And I think everyone would attest to the fact that, I know for me, when I go to the grocery store, $100 buys a lot less than $100 did at this time last year. Now, where this affects people is, I'm not sure if your average guy out there really even pays that much attention to what the government says inflation is. But what we are seeing in the actual numbers is that real disposable income is declining. And it's, I think I had the statistic in my last Short Sellers Journal or the one before that. And real disposable income is at multi-year lows. So that means take your household after-tax income, and what do you have left after you pay taxes? That's what your income is to spend on everything that you have to spend on every month. So your housing costs of maintaining the automobile, et cetera, et cetera. So and we're starting to see the effects of that show up in, for instance, retail sales. I mean, retail sales are on a downtrend. And same thing with restaurant sales. People have less money to spend when they go out to spend things on, money on things that they spend money on over and above necessities. And where it's going to get really interesting is in 2018, because I don't know about if it's true across all states, but I know in most states, healthcare premiums are rising anywhere from like 10% to as much as 100%. And that's going to really take a huge chunk out of the average household's disposable income in 2018.
Definitely. And I know you've also talked about the housing market. In 2008, we had this huge housing bubble, but depending on how you measure housing prices right now, you've noted that they're at all-time highs right now.
Yes. If you measure housing prices as a ratio of income, household income, you're by far at all-time highs. Housing, a new house, or a new existing house, the cost of a house has never been more expensive in U.S. history as a ratio of household income. So the affordability level is at an all-time low. And it was interesting because there was a survey that I believe it was Fannie Mae did. They release a survey every month. And in the most recent survey, might be every quarter, the most recent survey, the majority of the respondents said it's a better time to sell a house right now than to buy a house, which, I mean, that kind of makes sense given where prices are.
Do you see like another housing crisis in the near future then?
It's going to depend on how much longer the government can keep kicking it down the road by redefining what qualifies for a conventional mortgage. I mean, essentially, Fannie Mae and Freddie Mac and FHA mortgages replaced the subprime component of the mortgage market that was essentially responsible for the housing market bubble in the mid-2000s and then the 2008 collapse. So a lot of the private issuer subprime lenders like Countrywide are gone, Wash Mutual, et cetera. So the government came in and said, okay, we're going to take over Fannie and Freddie. And during the course of, say, since 2010, they've made it easier and easier to qualify for what they call a conventional mortgage. And it's at the point now where, and they just did this year, the original debt to income test, the DTI test, was 40%. So that means, and that's measured on a pre-tax basis. So your gross income to your monthly debt service. So what your mortgage costs would be plus car leases, car debt, credit card payments, etc. So your gross income before taxes had to be 40% of your monthly debt payment commitments. They moved it up to 50%. And so if you calculate that on an after-tax number, anyone who takes out a Fannie or Freddie mortgage with a 50% DTI is essentially spending probably close to 70% of their after-tax income just on debt service, including the mortgage. So that's, 10 years ago that would have been, or 15 years ago that would have been considered a subprime mortgage, and the government wouldn't have been able to even issue it. So that's just an example of how they've managed to kick the credit bubble down the road and extend it by continuing to lower the lending standards. So in a sense, the taxpayer is now the new subprime mortgage lender in this economy. I don't know how much farther they can push that. And to the extent that you kind of run out of the population of people who want to buy a house, but who can qualify to take out a big enough mortgage to buy a house, once that dries up and hits the wall, I think you're going to see the rug pulled out from under the housing market. And in terms of what the timing is on that, it's just like the first time around. I was early in calling the top of the housing bubble back then. I sold my house in late 2004. So it turned out my area kind of flatlined starting in early 2005. So where I was living, I didn't miss the top by too far. But I probably started calling the top a little too early this time around because I continually underestimate the capabilities of the government to use taxpayer money to finance people who otherwise can't service their mortgages or afford to buy a home. And I do think we're running low on the number of people who can fog a mirror and still qualify for a mortgage. And I think we're going to start, I think 2018 is going to be a very difficult time for people who want to sell their house or have to sell their house. If you have to sell your house, or you think you might have to in the next 6 to 12 months, I'd put it on the market now.
Now, coming full circle here, did you want to kind of reiterate for our viewers what you see the Fed doing in the future? Because we talked about at the beginning of this interview how they said they were going to normalize their balance sheet, but actually their balance sheet increased over the last 2 months since they made that announcement. So what do you see the Fed actually doing, and can you reiterate for our viewers what kind of effect that's going to have on them?
I don't know I don't think anyone really knows what the Fed's going to do. I don't know if the Fed knows what the Fed's going to do. They keep moving the line on how they decide to make their policy decisions. I don't think there's anyone out there who would disagree with the fact that if the Fed started removing liquidity and raising rates, they're going to tank the markets and it would collapse our financial system. And I'm sure they know that. And I'm sure that's why we've only seen two, and they're not even real rate increases, a quarter of a percentage point, 25 basis points. That's not even a real rate increase. Since Bernanke made his famous taper speech in May of 2013, interest rates have been risen a little over 1% since that time, from zero. I mean, that's negligible. And the Fed's kind of put itself in a corner here. They've targeted the stock market. They've targeted asset prices. I think the theory was that, oh, well, rising asset prices will make people feel richer, and they'll spend more money, and the velocity of money will increase, and we'll have escape velocity in the economy. Well, we haven't had that, because all we've had is massive asset inflation. It hasn't put more money in people's pockets. Maybe a little bit in terms of nominal income, but when you inflation adjust that by a real inflation number, people have less to spend now than they did 5 years ago. So, I don't know how the Fed addresses this. They could have addressed it in 2008 by just letting the system collapse, do what it was going to do. We'd probably be in the middle of a really nice, robust economic recovery right now. But they've made the situation worse. And quite honestly, I have no idea what they're going to do next. I can tell you that if they're not worried about the stock market and they're worried about properly applying monetary policy, they should be hiking rates up to 4 or 5% at least, probably higher, to reflect the true inflation rate. And they should start shrinking their balance sheet. Otherwise, we don't have real markets.
Definitely, and I, like you were saying, I'm not sure anyone really knows what the Fed's going to be doing next, but I'm sure at your blog, Investment Research Dynamics, you're going to be, keeping track of all of what they're doing as they're doing it. So if our viewers are interested in learning more, did you want to remind our viewers how they can find you?
Sure. My blog is at investmentresearchdynamics.com, and from there you can learn about my Short Sellers Journal, which is a weekly publication where I provide a lot of market commentary and economic and financial analysis that I don't put on my blog. And then I also have short sell ideas. The latest one in there was overstock.com. And the last time I looked, it's a little bit lower than where I recommended it as of Sunday night. And then I also have Mining Stock Journal. And I'm actually very excited about this upcoming issue on Thursday because Overstock's down over 5% today. I have a emerging junior exploration gold miner, and they've got a phenomenal property that's near the Carlin Trend in Nevada. And they also have a shovel-ready project. And I think this particular stock, without any movement in the price of gold, is probably worth right now intrinsically at least twice where the stock market is valuing it. So that company's going to be in there on Thursday night as well.
Once again, Dave Kranzler, thank you so much for your time today.
Thanks for having me, Elijah. It's always a pleasure chatting with you.